There's this old story you've probably heard, which is about an emperor who's obsessed with fine clothes. So he hires two tailors who actually are swindlers and who claim they can make him a magical fabric that is invisible to anyone who is stupid or incompetent. The emperor, not wanting to appear foolish, pretends to see the clothes, as do his ministers. When he parades through the city in his new clothes, no one dares to speak the truth until a little child with no agenda, no filter, blurts out, "But the king is not wearing anything." And suddenly, the truth was out there for everyone to see. In an investing world, we sometimes need that kid, someone brave enough to say, "Hey, something does not look right here." Recently, S. Naren, the chief investment officer at ICICI Prudential Mutual Fund, played that role. He did not sound the doomsday siren to tell everyone to pull their money out, but he did raise his hand and say that small and mid cap stocks and funds have gotten expensive, a fact we must not ignore. Naren has used a few examples to drive home his point. For example, he mentioned how SIPs done in Indian mid-cap funds between 1995 and 2002 would have delivered zero to negative returns. And between 2006 and 2013, SIP returns in mid-cap funds again were negative. Naren's note of caution comes at a time when these segments have been on fire. Investors, particularly retail investors, have been flocking to small and mid-cap funds because, let's be honest, the returns have been mouth-watering. Everyone loves a winner, and these funds have been delivering. Like the BSE Mid-Cap Index has delivered a compounded annual return of 21% of the past 5 years. And the BSE Small Cap Index has returned almost 26% compounded for the last 5 years. But as the emperor's tale reminds us, sometimes the crowd can get a little too carried away. And when someone with experience like Naren says, "Hold on, take a closer look," it's probably worth listening. So what has he actually said? He has not asked you to dump your SIPs and hide your money under the mattress. He's not predicting a market crash next week. He's simply saying, be careful. Valuations in small and mid-cap stocks and funds have run up a lot. And when valuations get stretched, future returns often cool down. And the risk of a sharp falls grows. In fact, Naren has gone a step further and said the outlook for SIPs in small and mid-cap schemes look unfavorable unless done for 20 years. And let's be honest, most investors don't stay invested in a fund for 20 years. They pull out far earlier, often at the wrong time, when the panic sets in. This naturally leads to the big question every investor is asking: should you stop your SIPs? The quick answer is probably not. SIPs are built to help you keep investing through markets' ups and downs, averaging your costs. When the market is up, you buy fewer units. When it's down, you buy more. Over time, this smooths out the bumps and helps you avoid trying to time the market, which is something even the professional investors struggle with. But Naren is reminding us of an important truth, which is that blind faith is not an investment strategy. Small and mid-cap stocks are naturally more volatile. They can soar when things are good, but they can also nosedive when sentiment turns. These companies are often more vulnerable to economic hiccups, and when prices are already high, any bad news can hit hard. That doesn't mean you should avoid small and mid caps altogether. They've created serious wealth for patient investors over long run. But you need to know what you are getting into. If you are only investing in these funds because your friend made a quick 30 or 40% return, or you saw a fund with insane returns, you need to check yourself. Ask this question: can I handle a 20-30% drop without panicking? This is why asset allocation is so crucial. It's important to take a step back and see if your portfolio is balanced. If small and mid caps have grown to dominate your investments because of gains in the past few years, maybe it's time to trim a bit. Move some profits into large cap or multi cap funds. These tend to be more stable and can balance out the inevitable swings in smaller stocks and funds. Ultimately, the core message is simple, and that is that valuations matter. No market segment is immune to gravity. What shoots up can tumble down. The best protection is ultimately a balance. A portfolio built around your goals, risk tolerance, and an understanding that markets move in cycles. So should you stop your SIPs in small and mid-cap funds? Likely not. Should you pretend everything is fine and carry on blindly? Absolutely not. Take this as a checkpoint. Review your investments. Make sure you are diversified. And ask yourself, am I investing with a plan or am I chasing what worked last year? Remember, the child in the emperor story didn't scream or panic. He just said what was obvious. Naren has done the same. He is not saying the market is naked. He's just asking you to look closely and make sure you see things as they are. And in investing, seeing clearly is half the battle. That's all from me for today. If this resonated with you, please like, subscribe, and share it with someone who might need to hear this. Stay calm, stay invested, and most importantly, play the inner game right. Thank you for your time.